What's up, everybody? Erik here. Welcome back to All the Outliers. I got a video for you today on bear markets do's and don'ts. I want to walk through some of my experience trading bear markets and then also stuff that I've found from analyzing the last 80 years of bear markets. I want to walk through some very specific things and then some contextual concepts. And then at the end of the video, I want to dive a little further into how we can analyze the current markets to understand what a bear market looks like, what we should be looking for in terms of a reversal or a bottom, those sorts of things. I do have a video coming out soon where I'm going to be actually analyzing, you guessed it, the last 80 years of bear markets one by one and walking us through how it played out, what it looked like, so that we can build up that pattern recognition. More to follow on that. But in the meantime, let's take a look at what is going on in the markets. As you all probably guessed, this is IWM because I trade it pretty frequently. For anybody that follows the channel, they know that. And I know that the bear market news for the S&P 500 is relatively recent. That is not the case with IWM. IWM's been in a bear market since November. Not quite that far back. Sorry. Definitely since April. And I think it was teetering into a bear market in February, which would be what, the 190 handle? Yeah, it would have been teetering around there because the 1 year high that I'm looking at here is 244.46. So long story short, IWM's been in a bear market for a minute now. And as of today, it is actually down 29.7% off of this 1 year high. So pretty deep bear market, not anything too crazy. We're not in the 40s or 50s yet, but nonetheless, a notable bear market. Now let's take a look at the SPY super quick for context. And again, using a 1 year chart, looking at this high that was set on the 4th of January, which was 479.98. And then as of today, we are 21% off of the 1 year high, and we are 20.4% down on the year. So using the open on the 3rd of January, because I don't think the market opened the 2nd. Yeah. So we can see that we're in a bear market, and a lot of things happen during bear markets. People are nervous. They get antsy. They're looking for answers. They want to know when their portfolio is safe again and all of this kind of stuff. So let's talk about some of the don'ts to kick us off, and more importantly, to not let you know my next move, because you probably were guessing we were going to do the do's first, but we're doing the don'ts. And the first one, this is general trading 101, but it really carries over into bear markets, is do not allow your losses to expand. Hope is not a strategy. So if you have a trade that you put on and you had a profit and loss target set at the onset, like you should for your trades, and it starts hitting that loss management, you're like, oh, well, I don't actually want to take this loss. I think it'll rebound. I think we're close. And then it turns into a bigger loss, and then it turns into a bigger loss still. That is a horrible approach. Now, if you're trading things like index ETFs, I would say you have a little bit more leeway, because I've never seen the SPY go to zero. Same thing for IWM, meaning sooner or later they rebound. But if you're trading things like options that are time bound, that adds another layer of friction to the trade, because now you can't just wait indefinitely. And if you're just hoping that your long calls are going to rebound over the next 2 weeks based on what we're seeing now, good luck to you, but it's not looking great. So keep a really tight hand on your risk during down moves. I know that sounds kind of counterintuitive, because a lot of people think that, oh, now's when you should be looking for market opportunity, which we'll talk about in a little bit. Don't allow your losses to expand. Keep your risk low. The next one, this is again a general trading thing, but it really rears its head in bear markets, is winging it. If you don't have a plan that you're following and you're just trying to find stuff that looks good and not really having a disciplined approach, it will show itself in the worst way during bear markets. Because during bull markets, if you're trading bullish strategies, you pretty much could throw a dart at the dartboard and do okay. That does not happen during bear markets, especially if you're trying to force a strategy. And what I mean by that is most people primarily trade bullish strategies. So if the hope is to continue to trade bullish strategies during a bear market, that's a square peg in a round hole. It doesn't work well. So by having a defined plan, it gives you a little more tools to pull out of that toolkit to form fit to the current markets, which we'll talk a little bit about on the do side. You kind of probably guessed this one was coming, but the bottom calling. People have been calling for a bottom for a hot minute now, and it's mind-boggling to me because when I look at the markets, I sit and think to myself, we're not even really starting a hard free fall yet. We saw a little bit of it here, but all in all, every single rally we've seen has been lightly supported, which we'll go into what to look for later. But all of the down moves have seen a ton of support. So what you see when people are saying and calling for a bottom, you're just seeing hopefulness. And again, as I already mentioned, hope isn't a strategy. So before you start trying to call a bottom, ask yourself, is this really a good time to enter a trade? If you're a long-term investor with a 10-year time horizon and you see something that looks good and you don't mind holding it for that time period, sure, have a ball, do your thing. It's a little bit different, but my approach to trading or investing is to minimize the amount of time I'm holding unrealized losses, waiting for them to turn to profits. It's inefficient and it doesn't make a whole lot of sense. Sometimes it's part of a strategy, no problem. But if you're doing it simply trying to bottom dip and really get the lowest tick before a big rally out, more often than not, you're going to be wrong. More often than not, you're going to be holding a losing trade until you either close a losing trade because you're tired of looking at it, which a lot of traders do, or you finally get a rally out after having an unrealized loss for, undefined period of time. Another thing that I see people do that is kind of a big problem is, especially for the people that aren't trading spreads necessarily, but trading single options, margin expansion. That gets a lot of people. When you are buying or selling options, buying options obviously a little bit different if it's just a single long option. But when you're trading options, there's a margin requirement. Your broker asks you to set aside a certain amount of money in your account to cover their risk. During bear markets or even just down moves, most brokerages will raise their margin requirements because they perceive more risk and they're not going to cover that risk for you. You have to have the capital in your account to cover that risk. So if you are trading and you're really trying to maximize your account, and I bring this one up specifically because it happened to me during 2008, I was within my margin limits. But then when things started to rebound out, I started scaling in a little bit more. Then we had a little bit of a double dip. And on that second dip, I found myself in a margin call because I was trying to maximize the use of the portfolio, but margin ended up expanding more than the account value. So then I had to add money to the account or close positions. That's the way to settle those margin calls. So I wasn't in a great spot, and it's because I didn't respect margin expansion. Well, how much does margin expand? How can you plan for it? It's really not that difficult. Most platforms will have a P&L visualizer, and I would pull that up and see what the margin requirement is calculated by your broker based on different moves. Most brokerages also put their margin requirement calculations out there, which is useful. However, that being said, it's still not perfect, and they can always ask you to put more in there. Again, just remember, they're not there to cover your risk for you. They're going to demand that you cover your risk as they calculate it so that they don't come into a series of defaults that they have to handle. Again, it's kind of a risky business, and we saw a lot of that during 2008, really on the housing market side via mortgages, but there's a lot of sensitivity to that now. We already talked a little bit about forcing strategy, so I'm not going to belabor the point. However, again, just realize if you're a one trick pony, if you only know bullish strategies, you're going to struggle. And that might mean you just need to sit on the sidelines or start scaling into a buy and hold portfolio during the bear market that you're going to hold for 3 to 5 years or whatever. And then you'll go back to trading when your conditions arrive. Just remember, the market doesn't care what you know. It doesn't care what you're comfortable with. The market's going to do what the market's going to do. So if you don't have the right toolkit to successfully deploy in that environment, it might not be the right place to trade. And that's no problem. But the big issue is when somebody says, well, I only know how to do vertical spreads, and so I'm just going to trade, bear vertical spreads. It might not be the right case for it, especially because you're going to see bid-ask spreads. Liquidity is going to widen out as things become more volatile. So people who are trying to trade vertical spreads are going to get torn apart more often than not on the bid-ask spread. All right, let's talk about some do's. Notice how I didn't include emotions on the don't. And it's because it's kind of like if you're having a fight with a significant other and you tell them to calm down or don't be angry. How many times have you said that to a significant other and they're like, oh yeah, okay, you're right. I'm just going to calm down right now. Just about never works. It's the same thing. I don't think the no works in this case. Don't be emotional. Unfortunately, we are predisposed to have emotions. They're going to be there. Now, what I will say is we can control our emotions if we acknowledge their existence and we acknowledge their tendencies. For example, one of my big emotions is when I see the markets moving and I perceive opportunity, I will attempt to move very quickly to try to capitalize on that opportunity. The problem with that emotion is I'm rushing. I'm not fully analyzing things. So I've put things in place to force myself to slow down. I've acknowledged that tendency and put a control in place so that it doesn't impact my overall profitability. But you got to start with this, because if you can't emotionally detach from your money in your account, you're going to have a hard time, especially even if you're holding an index ETF, you're planning on holding it throughout the year, and then it decreases by 40%. You're super emotional about that money. That's when people make a ton of mistakes. One of the best things I think to do is to go through the exercise of truly emotionally detaching from the money that you're putting into the account so that you can try to control the whole other slew of emotions you have, things like ego, without having that added component of, man, this is my life savings getting cut by 40%. Just be thankful you're not the Bitcoin people right now who are sitting there talking about, oh, I'd love to buy it at 20,000. And now they look at it like, ugh, I don't know if I still want this thing. Next one's self-explanatory. Follow your plan. I throw it in there because you should ask yourself in this video, do you have a plan? Because again, statistically speaking, the vast majority of people don't have one, or they have a shitty one. And that leads to this right here, winging it, thinking that we're just going to successfully figure it out on the fly. It doesn't work that way. I do not know why people think that you can try to expose yourself to the markets, myself included. I did this when I was early on because I didn't want to go through the effort of making a plan. It sounded boring, annoying. And I thought that I was going to be able to just figure it out on the fly and make money. And it's just so funny to me now because it's similar to trying to become an outlier in any other aspect of life by just winging it. If you said, well, I wonder if you could become a professional athlete without practicing, it sounds ridiculous. But that's the same thing a lot of retail traders, again, early, myself included, attempt to do. So if you don't have a plan, you should have one. And if you have a plan, maybe you should analyze, do you only have bullish strategies? Do you have bearish strategies in there? If you want to trade both sides of the market, you need both styles of strategies. Remaining patient, again, this kind of plays off of emotions, but the main thing I'm highlighting with remaining patient is if you have positions that are sized appropriately, you're trading your plan, but you get that red fatigue. And what I mean by that is when you open up your platform and it's red. And if you do that every single day for the average bear market duration of 298 days, you can start to get fatigued by that. And you can start to make poor decisions saying, you might have a great strategy to control a trade, manage it to a winner long term, but you get so tired of looking at the red that you're like, I'd rather just close this out and start all over again. That's not good. So do your best to control those tendencies if you have them. And this also leads into waiting for strength. So one of the things that I look at in the markets is the fact that I do not see strength at all. Even in this little bear market dead cat bounce rally, it wasn't well supported, which we'll talk about in just a second. So the main thing that I look at is if you're trying to deploy bullish strategies, rather than trying to bottom dip, get the lowest tick so that you get this miraculous run up, don't worry so much about that. But focus more on waiting for strength so that you're not holding an unrealized loss for an extended period of time, because more likely than not, most retail traders sell too early anyways. You're not trying to top ticket, and it's not an effective approach. Focus on trading your strategies where they align. Focus on making sure that the correct conditions exist instead of trying to force fit your deployment. You should form fit your deployment to the markets. And then deploy bearish strategies, self-explanatory, but again, this just goes off of this. Don't force what you're doing. All right, let's switch over real quick to talk about some of the things we should be looking at when we're analyzing bear markets, specifically for how it's playing out, what's going on here. Objectivity is one of my biggest pursuits when it comes to technical analysis, because technical analysis is very tricky. There's a lot of subjectivity that can be integrated into it. And the way that I go about it, I do my best to decrease that as much as possible so that it's as objective as possible. So I'm going to use things like trend lines. I'm going to use things like moving averages and volume. So let's take a look. As I'm looking at the current markets right now, I see a 1 year, 1 day chart in the SPY. The linear regression channels, using this to help me understand trend, are downward sloping. That's bearish. That's not good. Normally, I would flip between the 1 year and the 6 month. And you can see on a 6 month, it's even worse still, which typically I would expect to see a little more aggressiveness in the 6 month over the 1 year, but both of them aren't good. Now, just for context, this is what it looks like during a bullish period. So this is a 3-year weekly, and on a 3-year weekly, we're still in a bullish overall trend. And if I look down to a 2-year, same thing there still, where the linear regressions are still overall bullish. Now, let's get back into looking at this bear market that we know is going on. The very first thing, obviously, is we have a bit of a top going on up here. That is clear as day, and it hasn't been really approached since. So all in all, we have that top hanging out. We know that the linear regression channels are negative sloping. There's a couple other specific trend tools that I want to point out. The very first one is all of these areas of relative chop, kind of these zones in here. All of this becomes resistance when the market does at some point attempt to rally. So when we start seeing price trying to move its way up out of here, it's got to work through all of this newly established resistance zones, which is useful information because as we're trying to understand where to weight our money in our effort, knowing where resistance has been built is important, and then especially in like these really tight ranges. Now, let's just look at a couple trend lines. And to be clear, I wouldn't draw all this stuff on a chart at once. This is just kind of to help explain a couple different ways to look at it. But if we look at some sort of general channel here, it is very much downward sloping. So we're in negative linear regression channels, just negative regular price channels. And all that's showing us is that we're seeing lower highs and lower lows. All of that is pointing to the downside. The next thing to take a look at is how is price moving in relation to volume? So when we look at how price is reacting during down moves. So if we take a look at this period here, like the 4th of May down here to the 12th of May, what does the volume look like? And as we look down here, it's actually above this 70-day volume average. And it's even approaching some of the shorter term 7-day volume averages, which gets skewed over time, which is why looking back that far, you can't get a super clear picture. But nonetheless, my point being is when we're moving down, there's a lot of people stepping into the market. Don't ever forget the market is a function of supply and demand. That's it. So we're seeing a ton of supply stepping into the markets on these down days. Then when we did get this little rally out, notice a couple things. The very first one is the volume was so light. It didn't even touch the 70-day average. It was gapped below it. The other thing to note is as we try to successfully punch through this 415 handle, notice how volume was actually tailoring down. We were seeing less support holding those levels. And then as soon as we started to resume the sell-off, volume skyrocketed. So all in all, again, a ton of bearish play there. The last thing, really one of the easiest things to keep an eye on, are the moving averages. The moving averages right now are completely inverted. Those are the blue lines that you see here. So I have a 150-day, a 50-day, a 20-day, and a 9-day. They're completely inverted. Normally, we would want them ascending in order from top to bottom, but we see them descending. So we have the long term above the slightly less long term, above the midterm, above the short term. All of that's not good. Typically, we would want to see that inverted like you see over here, where we had this nice rally out. We had short term at the top and then increasing as we move down to the bottom to the longer term moving averages. Seeing these longer term moving averages, especially as 150-day flatten out, is a huge red flag. And then seeing it actually rolling over and downward sloping is a gigantic red flag. So there is a ton of information to extract from the current market movements, but the punchline here is that none of this looks like a bottom to me just yet. It's not to say that it can't form, not to say that it's not around the corner, but if I were to guess, it's not. The average bear market's 298 days. My assessment is that we got a long way to go. Again, I have another video that will do a deeper dive into bear market analysis in and of itself. Just wanted to throw a little bit of how I'm looking at the current markets just for general consumption. And don't allow your account to get zeroed out in a stupid play trying to guess the bottom. It is so dumb. Wait for some support. Wait for the moving averages to invert. Wait for volume on actual bull rallies, things like that. So if the video is helpful, like it. That helps me know that what we're working on is helpful for you. And then more importantly, it allows us to emerge from the evil YouTube algorithms. They're actually not evil. They're pretty equitable, but it helps us grow our community, which is a big goal of mine. So make sure you like the video, subscribe to us, check us out. We have a Discord that's completely free in the video description. If there's anything that you want to see us talk about, let me know. Throw it in the comments, or if you have anything that you would add to the do's and don'ts. That would also be really helpful for other people that check the video out. And it's a way to source knowledge from the community, which is super helpful. So I would appreciate that as well. As always, if there's anything you all need, let me know. And until next time, be an outlier. Catch y'all later.